This video provides an overview of the major concepts covered in Chapter 11, Stock Valuation and Risk. Because stock values change continuously, so do stock prices. Institutional and individual investors constantly value stocks so that they can capitalize on expected changes in stock prices. Chapter 11 includes 7 learning objectives. First, to explain methods of stock valuation. Second, to explain how to determine the required return on stocks. Third, to explain the factors that affect stock prices. Fourth, to explain how to measure the risk of stocks. Fifth, to explain common methods of measuring risk-adjusted stock performance. Sixth, to explain the concept of stock market efficiency. And the last learning objective is to discuss foreign stock valuation and performance. Let's start by looking at how stocks are valued. Investors conduct valuations of stock when making their investment decisions to consider investing in undervalued stocks or selling their holdings of stocks that they consider to be overvalued. A relatively simple method of valuing a stock is to apply the mean price earnings or PE ratio based on expected earnings rather than recent earnings of all publicly traded competitors in the respective industry to the firm's expected earnings for the next year. Consider a firm that's expected to generate earnings of $3 per share next year. If the mean ratio of share price to expected earnings of competitors in the same industry is 15, then the valuation of the firm shares is $35, calculated as the $3 expected earnings per share of the firm multiplied by the mean PE ratio of 15. The PE method has several variations which can result in different valuations. For example, investors may use different forecasts for the firm's earnings or the mean industry earnings over the next year. The previous year's earnings are often used as a base for forecasting future earnings, but recent earnings do not always yield an accurate forecast. The PE method may result in an inaccurate valuation of a firm if errors are made in forecasting the firm's future earnings, if the firm uses creative accounting methods to exaggerate earnings, if there's inconsistent agreement on industry norms, and distortion in earnings due to stock buybacks. Another method used for pricing stock is the dividend discount model, or DDM, where the price of a stock should reflect the present value of the stock's future dividends using this formula. There are 2 applications of the dividend discount model to consider. The first is based on a constant dividend. Now consider a stock that's expected to pay a dividend of $7 per share annually forever. This constant dividend represents a perpetuity, and thus the present value of the cash flows or dividend payments to investors in this example is the present value of a perpetuity, which is calculated simply as the dividend D divided by the required rate of return K. Assuming that the required rate of return on the stock of concern is 14%, the present value of the perpetual $7 dividend is $7 divided by 0.14, or $50 per share. Unfortunately, the valuation of most stocks is not this simple because their dividends are not expected to remain constant forever. If the dividend is expected to grow at a constant rate, however, the stock can be valued by applying the constant growth dividend discount model, where the present value of a stock equals the next year's dividend D1 divided by the rate of return K minus the rate at which the dividend is expected to grow, G. For example, if a stock is expected to provide a dividend of $7 per share next year, the dividend is expected to increase by 4% per year, and the required rate of return is 14%, the stock can be valued as $7 divided by 0.14 minus 0.04, or $70 per share. The dividend discount model and the PE ratio might seem to be unrelated given that the DDM is highly dependent on the required rate of return and the growth rate, whereas the PE ratio is driven by the mean multiple of competitor stock prices relative to their earnings expectations and by the earnings expectations of the firm being valued. Yet the PE multiple is influenced by the required rate of return on stocks of competitors and the expected growth rate of competitor firms. Thus, when using the PE ratio for valuation, the investor implicitly assumes that the required rate of return and the growth rate for the firm being valued are similar to those of its competitors. The dividend discount model may result in an inaccurate valuation of the firm if errors are made in estimating the dividend to be paid over the next year, or in estimating the growth rate, or the required rate of return by investors. The limitations of this model are more pronounced when valuing firms that retain most of their earnings rather than distributing as dividends, because the model relies on the dividends as the base for applying the growth rate. The dividend discount model can be adapted to assess the value of any firm, even those firms that retain most or all of their earnings. From the investor's perspective, the value of the stock is equal to the present value of the future dividends to be received over the investment horizon, plus the present value of the forecasted stock price at which the stock will be sold at the end of the investment horizon. To forecast the sales price, investors must estimate the firm's earnings per share in the year that they plan to sell the stock. The estimate is derived by applying an annual growth rate to the prevailing annual earnings per share. Then the estimate can be used to derive the expected price per share at which the stock can be sold. Assume that a firm currently has earnings of $12 per share. Future earnings can be forecasted by applying the expected annual growth rate to the firm's existing earnings, E, where the forecasted earnings in N years equals E times 1 plus the growth rate, G, to the exponent of N. If investors anticipate that the earnings per share will grow by 2% annually and expect to sell the firm's stock in 3 years, the earnings per share in 3 years are forecast to be $12.73. The forecasted earnings per share can be multiplied by the P/E ratio of the firm's industry to forecast the future stock price. For example, if the mean P/E ratio of all other firms in the same industry is 6, the stock price in 3 years can be forecast as the $12.76 earnings in 3 years multiplied by the industry P/E ratio of 6 to end up with $76.38. The forecasted stock price can be used along with the expected dividends and the investor's required rate of return to value the stock today. If the firm is expected to pay a dividend of $4 per share over the next 3 years, and if the investor's required rate of return is 14%, then the present value of expected cash flows to be received by the investor is $60.84. Limitations of the adjusted dividend discount model include present value calculation errors of dividends over the investment horizon, the present value of the forecasted price at which the stock can be sold at the end of the investment horizon, or using an incorrect rate of return. For firms that don't pay dividends, a more suitable valuation may be the free cash flow model, which is based on the present value of future cash flows. It involves 3 steps. First, to estimate the free cash flows that will result from operations. Second, to subtract the existing liabilities to determine the firm value. And third, to divide the value of the firm by the number of shares to derive a value per share. Now, a key limitation of this model is the difficulty in obtaining an accurate estimate of the free cash flow per period. Now let's move on to the next major concept in the chapter relating to the required rate of return on stocks. The capital asset pricing model, or CAPM, is sometimes used to estimate the required rate of return for any firm with publicly traded stock, and is based on the premise that the only important risk for a firm is systematic risk, or the risk that results from the exposure to the general stock market. The CAPM calculates the required return of a stock, RJ, as the prevailing risk-free rate, RF, plus the stock's beta, BJ, multiplied by the market return, RM, minus the risk-free rate, RF. The yield on newly issued treasury bonds is commonly used as a proxy for the risk-free rate. The term within the parentheses in the previous equation is the market risk premium, or simply the return of the market in excess of the risk-free rate. A stock's beta is typically measured by applying regression analysis to determine the sensitivity of the asset's return to the market return based on monthly or quarterly data over the last 4 years or so. However, estimated betas for most stocks are reported on financial websites and by investment services. Given the risk-free rate as well as the estimates of the firm's beta and the market risk premium, it's possible to estimate the required rate of return from investing in a firm's stock. For example, assume the beta of Vaxon Inc. stock is estimated to be 1.2. If the prevailing risk-free rate is 6% and the market risk premium is estimated to be 7% based on historical data, a stock's risk premium is computed as the market risk premium multiplied by the stock's beta. So Vaxon stock's risk premium above the risk-free rate is 7% times 1.2, or 8.4%. We can then determine the required rate of return on Vaxon stock to be 14.4%, calculated as the 6% risk-free rate plus the 8.4% risk premium, or 1.2 times 7%. Now let's briefly discuss some factors that affect stock prices. A firm's value should reflect the present value of its future cash flows. In turn, investors should consider various economic factors that affect a firm's cash flow when evaluating a firm to determine whether its stock is overvalued or undervalued. The key economic factors that can affect stock price include the impact of economic growth, the impact of interest rates, and the impact of the dollar's exchange rate value. Market-related factors also drive stock prices. The first factor is investor sentiment, which represents the general mood of investors in the stock market. And the second major factor is the January effect, where many portfolio managers prefer investing in riskier small stocks at the beginning of the year and then shifting to larger, more stable companies near the end of the year to lock in their gains. A firm's stock price is adjusted not just by macroeconomic and market conditions, but also by firm-specific conditions such as a change in dividend policy, earnings surprises, and acquisitions, where if a firm is expected to be the target of an acquisition by another company, its stock price often increases. Tax laws can affect the after-tax cash flows that investors receive from selling stocks, since short-term and long-term capital gains are taxable. This in turn affects the demand for stocks and therefore impact the stock price and ultimately the return to the investor after selling it. This exhibit illustrates the underlying forces that can cause a stock's price to change over time. As with the pricing of debt securities, the required rate of return is relevant, as are the economic factors that affect the risk-free interest rate. Stock market participants also monitor indicators that can affect the risk-free interest rate, which in turn affects the required return by investors who invest in stocks. Indicators of inflation and of government borrowing also affect the risk-free rate, thereby influencing the required rate of return by investors. In addition, it's common practice to estimate expected cash flows when deriving a firm's value, and these cash flows are influenced by economic conditions, industry conditions, and firm-specific conditions. Many market participants seek what Wall Street refers to as an edge, which is an information advantage of typically private information over other investors. Institutional investors that possess an edge should be able to outperform other investors, which may enable their portfolio managers to charge higher fees or to justify taking a larger share of the profits generated by their portfolios. Ethical concerns in this area include information leakages to analysts and clients prior to public announcement, and reliance on expert networks who might possess material inside information relating to a firm. Now let's move on to discuss stock risk. A stock's risk reflects the uncertainty about its future returns, which may be less than expected and therefore affect the estimates of future cash flows. The main source of uncertainty is the price at which the stock will be sold, since dividends tend to be much more stable than stock prices. A stock's volatility serves as a measure of risk because it may indicate the degree of uncertainty surrounding the stock's future returns. Contributors to the volatility of a stock include the standard deviation to forecast the stock price volatility, using volatility patterns to forecast stock price volatility, using implied volatility to forecast stock price volatility, forecasting stock price volatility of the stock market, and volatility of a stock portfolio. Now, as explained earlier, a stock's beta measures the sensitivity of its returns to market returns. This measure of risk is used by many investors who have a diversified portfolio of stocks and believe that this strategy diversifies away the unsystematic risk of the portfolio. This exhibit shows how the probability distribution of a stock's return depends on its beta. At one extreme, stock A with a very low beta is less responsive to market movements in either direction, so its possible returns range from only negative 4.8% under poor market conditions to 6% under the most favorable market conditions. At the other extreme, stock D with a very high beta has possible returns that range from negative 11.2% under poor market conditions to 14% under favorable market conditions. This stock is perceived to be risky because it experiences larger losses when the stock market conditions decline. Portfolio risk can be measured based on the betas of the component stocks weighted by the proportional investment in each stock. That is, the portfolio beta is a weighted average of the betas of the stocks that make up the portfolio, where the weights reflect the proportion of funds invested in each stock. Value at risk is a measurement that estimates the largest expected loss in a particular investment position for a specified confidence interval. It's intended to warn investors about the potential maximum loss that can occur. A common method for applying value at risk is to measure the stock's standard deviation of daily returns over the previous period and then apply it to derive boundaries for a specific confidence level. Once the maximum percentage one-day loss for a given confidence level is determined, that value can be applied to determine the maximum dollar one-day loss of a particular investment. The value at risk method is used to measure the risk of a stock portfolio in the same manner that it is applied to measure the risk of one stock. An investor who wants to assess the maximum loss over a weekly instead of daily investment horizon can apply the value at risk method to a series of weekly instead of daily historical stock returns. A common criticism of using historical periods to measure value at risk is that portfolio managers may rely on a relatively calm historical period when assessing possible future risk. Now let's discuss measuring risk-adjusted stock performance. The performance of a stock or a stock portfolio over a particular period can be measured by its excess return, that's the return above the risk-free rate, for that period divided by its risk. Two common methods of measuring performance are the Sharpe index and the Traynor index. Both indexes measure the excess return above the risk-free rate per unit of risk. However, the indexes differ in the proxy used for risk. If volatility or variability of stock returns is deemed to be an appropriate measure of risk, a stock's risk-adjusted returns over a period can be determined by the reward to variability ratio, also called the Sharpe index, which is calculated as the difference between the average return on a stock, R bar, and the average risk-free rate, RF bar, divided by the standard deviation of the stock's return. If the stock's average return is less than the average risk-free rate, the Sharpe index for that stock will be negative. The higher the stock's mean return relative to the mean risk-free rate, and the lower the standard deviation, the higher the Sharpe index will be. To illustrate, let's assume the following information for two stocks over a 3-year period. The average monthly return for Sooner stock is 1.2%. The average monthly return for Longhorn stock is 1%. The annualized risk-free rate is 0.3%. The standard deviation of Sooner's monthly stock returns is 2%, and the standard deviation of Longhorn's monthly stock returns is 1.4%. We can calculate the Sharpe index for Sooner's stock to be 0.45, calculated as Sooner's 1.2% average monthly return less the 0.3% risk-free rate divided by Sooner's standard deviation of monthly stock returns of 2%. We can similarly calculate the Sharpe index for Longhorn to be 0.5, calculated as 1% less 0.3% divided by 1.4%. Now, even though Sooner stock had a higher average percentage return, Longhorn stock had a higher performance based on the Sharpe index because of its lower risk. If beta is thought to be the most appropriate measure of risk, a stock's adjusted risk returns over a period can be determined by using the Traynor index, computed as the differences between the stock's average return and risk-free rate, divided by the stock's beta, B. Using the information in the preceding example on Sooner's stock and Longhorn stock, and assuming that Sooner's stock beta is 1.1 and Longhorn's beta is 1.0, the Traynor index is calculated for Sooner to be 1.2% less 0.3% divided by Sooner's beta of 1.1 to end up with 0.82. Longhorn's Traynor index is similarly calculated to be 0.7. Based on the Traynor index, Sooner stock experienced higher performance than did the Longhorn stock. The next concept in the chapter relates to stock market efficiency. If stock markets are efficient, the prices of stocks at any point in time should fully reflect all available information. As investors attempt to capitalize on new information that's not already accounted for, the stock prices should adjust immediately. Efficient stock markets can be classified into 3 forms: weak, semi-strong, and strong. Weak form efficiency suggests that security prices reflect all market-related information such as historical security price movements and the volume of securities trades, and investors will not be able to earn abnormal returns on a trading strategy that is based solely on past price movements. Semi-strong form efficiency suggests that securities prices fully reflect all public information. The difference between public information and market-related information is that the public information also includes announcements by firms, economic news or events, and political news or events. In this case, investors could earn abnormal returns by using the relevant information that was not immediately accounted for by the market. Strong form efficiency suggests that securities prices fully reflect all information, including private or inside information. If strong form efficiency holds, semi-strong form efficiency must hold as well. If the inside information leads to abnormal returns, semi-strong form efficiency could hold even though strong form efficiency does not. Tests of market efficiency are segmented into the 3 categories. Weak form efficiency has been tested by searching for a non-random pattern in securities prices. If the future change in price is related to recent changes, historical price movements could be used to earn abnormal returns. Semi-strong form efficiency can be tested by assessing how security returns adjust to particular announcements. And finally, tests of strong form efficiency are difficult to perform because the inside information used is not publicly available and cannot be properly tested. The last concept in the chapter relates to foreign stock valuation and performance. Like domestic stocks, foreign stocks can be valued using the price-earnings method or the dividend discount model with an adjustment to reflect international conditions. Some foreign markets are likely to be inefficient because of the relatively small number of analysts and portfolio managers who monitor stocks in those markets. It's easier to find undervalued stocks when a smaller number of market participants monitors the market. The returns from investing in foreign stocks are most properly measured in terms of the investor's objectives. A substantial amount of research has demonstrated that investors in stocks can benefit by diversifying their stock portfolios internationally. Emerging markets provide an alternative outlet in which investors from the US and other countries can invest their funds. The potential economic growth rate in such countries is relatively high. In addition, investors may achieve extra diversification benefits from investing in emerging markets because their respective economies may not move in tandem with those of the more developed countries.